Welcome to Northwest Arkansas Investing Podcast, your go-to source for real estate investing in Northwest Arkansas.
Whether you're a seasoned investor just starting out, we bring you expert insights, market trends, and practical strategies to help you build wealth through real estate.
From buying and selling to property management and long-term investment planning, we cover it all so you can make smart, informed decisions in this fast-growing market. Let's dive in.
Welcome back to the NWA Investing Podcast with my co-host Brandon Still. Today's topic, we're talking about deal structuring, effective structuring for beneficial partners. So,
love it. Yep, I think this is a really good topic for a lot of folks out there, whether they're just getting started or whether they've been in it a long time, or even just kind of even if they've invested as an LP, a limited partner in previous deals, but maybe haven't seen what structuring partnerships looks like from the outside, and maybe from others like yourself, Brian, and so I think we want to dive into some of these topics, and really just kind of how it evolves over larger partnerships, units or deals that are 10 million plus, or let's say 20 plus units or whatever, and then even how Brian and myself have looked at deals from a partnership perspective. Even when they're smaller and 2 to 24 units, if you will. So Brian, I'd love to dig into some of these topics. I think just some simple terminology that you'll hear from a lot of investors, I think would be good for those to know. What is GP and LP? You hear a lot of that out in the market. Investors will be talking about GP, LP. Just for those that don't know that, what does that mean?
The general partners are the active partners in the deal. They're the ones who are setting up legal, lending, asset managing, construction management, and seeing the property through. And the limited partners are the investor partners. They're going to be limited in their liability to the amount they invest. So they essentially, depending on how you set it up, usually will have no say in the project. So if you're an LP, you definitely want to understand the structure. You want to understand the GP, who the GPs are on their deal, their track record, their experience, their business plan, their underwriting. So simple terms, general partners are the active partners, and limited partners are the quote unquote passive investor partners.
Yep, and limited partners. I think that's a good way to put it. Like you said, they're only limited to their liability, and are oftentimes silent partners, just the money, right, and not necessarily have any say in kind of what's going on. I think that's one of the biggest building blocks when it comes to deal structure and kind of what partnerships look like. What do you see out there? I know this is going to look different from smaller deals to larger deals, but Brian, I know you've done both. So what is, when it comes to a smaller project, maybe it's a duplex, maybe it's all the way up to 24 units, or maybe even a little bit bigger. On smaller deals, what are typical partnership structures that you've seen out there?
Yeah, on the smaller deals, I think it ranges pretty far from 50-50 partnership, where 50% of the profits are going to the limited partner and 50% are going to the active partners, to as high as 90% going to the limited partners and 10% going to the managing partners. And then sometimes you'll have fees on that, fees paid to the general partnership for all the work that they did putting the deal together and all the deals that didn't come together before that deal. So me, typically, I should generally charge no fees or very low on my deal structures, but you can see those as high as 5%. I would be very hesitant to invest in anything with higher than 1 to 3% fee. It is reasonable for the general partners to put it together, even though I don't usually charge it. It is a reasonable. It's pretty common you see out there. And then for LP, GP split, anywhere from 50-50 to 90-10. You want to clarify with your partnership if your investment is being paid back before that. So if I'm investing $500,000 in a deal, is the profit structure 80-20 to me, 80% to me, until I achieve my capital back, or is that after I get my capital back? So, as an investor, I also invest as a limited partner too. I would want my capital back before there's any sort of profit share.
Yeah.
So
That makes sense.
another thing that is also out in the market is a preferred return. That's more common in the syndications where, if I'm investing 100,000, and there's an 8% preferred return, that means that I'm getting 8% paid back before any sort of splits, whether that's 70-30, 80-20, 90-10.
Yeah. And is that, what kind of distributions would you normally see on something like that on a preferred return? Is that like a monthly or quarterly, or is it
Monthly,
on sale? Or?
yeah, monthly, quarterly. It depends on the business, depends on the asset. Usually existing, you're going to have a lot higher cash flow than like a development project where that preferred return's probably accruing, where, you don't have 3 years of cash flow. So if you have a preferred return, that means that's accruing to you. You can get as complicated as you want. You could have an 8% preferred return. You can have waterfall hurdles where, once the investor achieves 16, 18, 20%, then it goes to 50-50. So it could start off as 8% preferred return, 60% to the investor, 40% to the managing partner, and then when they achieve 18, when the investor gets 18%, then it goes to 50-50. Those kind of waterfall hurdles and preferred returns and fees are much more common on large deals, where it's 5 million and up, where you have more investors and maybe more general partners on the deal, where there's a little bit more work going in on that. Typically, it's usually at 80-20. Like my bread and butter is just an 80-20 straight split, where I don't charge any fees to the deal. I'm getting 20% quote unquote sweat equity for putting the deal together and managing it, and then my investors get 80%. Usually how.
So typically the way those are set up, I know, yourself as a GP, you normally would be the deal finder and putting the deal together, and normally, like you said, there's that sweat equity, or maybe, if let's say you're doing an 80-20 split, do you typically, as a GP, or if you're getting the 20% split, just for those that are like trying to figure out how to set up their partnerships, is that typically how the initial investment is as well? Or is there, let's give you an example, for $1 million deal, for the 250,000 that they need down or whatever, would that be evenly split? Like the 80% partner would put 80% of that 25%, and then the other partner would put the 20%, or how do you normally see like the initial investment too?
For me, I'm usually not putting, besides my time and probably some money, like touring the property and doing the due diligence on the property, have some kind of risk capital and maybe an earnest money deposit. But for me, I usually not putting like 20% of the required capital, but you want to see the general partnership having some sort of skin in the game, especially if there's a fee. If there's not a fee, then, like for me, my argument is I'm not getting paid until if I don't have a fee, I'm not getting paid till my investors are getting paid. So I'm essentially working for free until my investors are paid back. But it's not uncommon for the general partner to also invest. If the general partner is also investing, usually you see that they'll probably have a little bit more of that 20% then. Maybe their contribute is weighted towards that 80-20 too.
That's a good point. I think that's something to remember for those that, maybe you're looking to, you'd like to start in a little bit higher bracket and maybe not buy a duplex or a fourplex or whatever, but you'd like to buy some bigger deals, but you don't necessarily have the cash to do so. Really an opportunity for any investor out there, if you want to start getting into these bigger deals, is finding a way to find the deals and put the deals together and earn your way into a spot. And in my opinion, and you probably say the same, there's no reason to be scared to give up equity, I guess, if you will. Like it sounds like your willingness in some of these deals to give up a good portion of the equity, but still get to have a piece just for putting the deal together but not having to have the initial capital investment, if that makes sense.
100%. In my pitch to like my investors who have, their own businesses that are making them multiple six figures or multiple millions, their time is better spent building that business than going chasing down a deal where they may they're going to keep an extra 20%, but at the same time they're taking time away from their business, their corporate ladder, their family, and they may not even achieve the same return. They may not even achieve the same profile of returns as someone who's out there, has access to really good deals, has a good team to manage and execute on operations, where they may end up making 10 or 15%, where if they would have invested with someone else, give up some control, give up a little like of the quote unquote equity, but they usually you can make better return. Just like a good lender or a good CPA or a good broker, you're paying that service to not have to do it yourself. Usually they're getting that, you're earning that back.
Yeah, that makes sense. I love that. Help walk me through some of these creative structuring and options that you mentioned there. Some of these I'm not even as familiar with. So I'd love you to kind of run us through this.
Yeah, so we have on here preferred equity. So that's usually seen on much larger deals, 5 million, 10 million. That's something that comes in behind preferred equity and mezzanine debt. It's coming in behind the lender. So the lender might loan up, 65% or 70%. Then you might have preferred equity come in and lever it up to 80%. So, the bank's lending 6.5 million, and then you have a preferred equity come in for 1.5 million, and then the investors are bringing in that extra 2 million, the equity. So it'll sit in second position above your equity. Usually it's a higher percentage. Usually it's anywhere from 12 to 16%, but it's a set return. So, the argument to use preferred equity is if I can make above 12 to 16% on my real estate deal, which you should. I'm not going to do a deal if I think I'm making 12 or 16%. I try to go for 20% net to my investors at least for me to do a deal on an annual basis. But if you're making above that, then theoretically it makes sense to pay that out. But you want to be careful because sometimes that preferred equity will also have additional fees. Obviously, your lender has fees. Those can range quite a bit, but the preferred equity will have a little bit of fees, and then which adds extra stress to the deal. Any fees to a deal adds stress to a deal. That's money that's not going back into the property. That's money that's just going to your basis. Now you're going to have to recoup that on the sale by forcing the appreciation versus money towards CapEx or money towards the property that's immediately going to the value. So it's also another partner in the deal, but it can help on larger deals and can help the returns. So I would just be careful on that. Some of those guys are you want to be careful with on how they structure it, if they have takeover rights like the lender. So it's just another tool to use for the larger deals. Yeah,
that makes sense. And then one that's standing out to me here is co-GP partnerships. For you, is that typically, like let's just say it's a 50-50 split, or is that where there'd be co-GPs and LPs in the deal? Where do you normally see that play out?
Yeah, so, previously I was with a syndication company for a couple of years. That was much more common in the larger deals when I was syndicating deals where it's a $20 million deal and you're going to have to raise $5 million, and, you have a couple partners that bring in additional capital. So you have access to $1 million of capital. Sometimes they'll get a piece of the GP. That you're supposed to have other roles besides just raising the capital. Maybe they have some asset management experience, some marketing experience. So that 20 to 40% that's carved out for the GP, sometimes that's not just one GP, that's multiple partners. One partner might be boots on the ground. One partner might be raising the equity. One partner might be leading construction and asset management. So that 20 to 40% can be carved up between the different GPs and their responsibilities.
Gotcha.
definitely want to be clear with those roles and responsibilities. There's a development project I'm looking at in here in Arkansas, and one of the partners wants to kind of lead the construction, and then one of the other partners wants to lead the financing and the asset management and the operations. Just make sure you have those spelled out, because it's all good until when you close the deal, and then some people have other priorities, and you want to make sure it's really spelled out in an operating agreement. So have a good attorney and make sure everybody's on the same page at the beginning.
Yeah, that makes sense. Seems like those could, you definitely want to make sure you have the right partners if you're going to be co-GPs with them, because there's a lot of responsibilities involved, and so good.
You want to make sure you're adding value to each other, and make sure you're not partnering up just a partner. I see a lot, and on the other token, I see a lot of newbies like wanting to partner up.
Yeah.
It's like two newbies aren't really adding. But yeah, that's great. You're both exciting and learning about real estate, but I would probably advise maybe you guys just, quote unquote, pick each other brains and stay in touch. But you want to have some added value to the partnership.
Yeah. For those, I guess, newbies, if you will, do you think there's more value in them trying to go, find a way to do their own first deal at least, and then getting into a partnership afterwards, and that way they have at least some experience to be able to do into a partnership and see, want the same out of their partner? Is that kind of what you would recommend?
I think so. I think it's good experience. You can, I say starting small is good. I'm not like you have to buy a big deal your first deal. Like I think starting small has a lot of value, and putting together a deal and seeing it, it falls on you. But at the same time, there is value, and even if you are a newbie, maybe you're the one finding the off-market deal, and that's the value you bring to a partnership. But that's the only thing that you really know how to. Or maybe you have access to capital, and someone's a strong operator, and maybe it's your own capital, or maybe it's not your own capital, but you could have access to the capital that's interested in real estate. So those are usually the two big opportunities for co-GPs, I think, is finding a deal or finding equity in a deal.
That makes sense. Man, Brian, just as we wrap up, I think just kind of to give some, would love to hear kind of any stories that you have on, red flags that you've come across in partnerships, or maybe any stories of lessons learned from a partnership that went bad, and maybe how you'd change that around. Anything that comes to mind on that?
Yeah, I think, I think spelling out the roles and responsibilities in the beginning is super important. Making sure everybody has a very clear understanding of the business plan. Stress testing all, any deals to worst case scenarios, best case scenarios, what happens in those worst case scenarios, what happens if there's extra capital, how are we mitigating that risk to not need extra capital. I think deal structure works. What I've seen is just having low fee, make sure it's equity based. I think I've seen where it's high fees have just killed a deal, where it's doesn't really make sense. And then also having a high level of understanding of underwriting assumptions, I think is super important. Some people is like, oh, that's great, this is showing a 30% return or 25% return. That looks great on paper, but anybody can make numbers dance on a paper. You have to really have a good understanding of how you're getting to this business. What are we assuming that is going to happen to make this property successful? What do we have to do to make those assumptions? So having a very good understanding of that. If someone doesn't have an understanding of that, that would be a big red flag. That's my biggest red flag. That's great. If someone doesn't know.
Yeah. So in your opinion, especially really if someone's going to be a GP with you, a general partner, or you're doing any kind of partnership, you would want them to, let's say you got a new deal to your desk, you would want to separately underwrite these and come back together, or at least so they would understand.
I think that's a good practice. Yeah. Underwriting them separately, or even just going through the underwriting together and seeing what they think is feasible and how you're coming up with those assumptions.
Yeah, that makes sense. Yeah, I think that's big. And then I think even going back to what you said, understanding the deal, understanding incentives, and then roles kind of laid out in the operating agreement, really big options there. And then I think just as we wrap up too, I think one big thing that I took away too is just the fact of, you don't necessarily need money either to do deals. And I think you've done that time and time again too. Sounds like you may have another one coming up that, being a deal finder and being the one out there kind of pushing the pedal to bring opportunities to the table can really set you in a spot where you can either have equity in a deal or, be able to project you into future deals as well. So I think that's great. I think partnerships in general can be tough, and I think people always say like don't do partnerships with family. You do that, and it sounds like it goes really well. Some people say don't do partnerships with friends. A lot of people that I know do partnerships with friends, and they love it, and they wouldn't do it any other way. So I think going back to some of these building blocks, like you said, of just understanding the roles, understanding incentives, and then really as people, anybody in the deal should really understand what they're getting into and understand kind of how the deal will work, worst case scenario and best case scenario. So any thoughts to wrap that up?
That was a great recap. I think that's perfect. Experience is important too. Make sure like who's got the experience in the certain whatever their role is. That's great to detail out the roles and responsibilities and what type of past experience does that person have in that asset class, in that role, and how can they bring that to the table.
Love it. Well, thanks for tuning in for another episode here, just talking through deal structure, partnerships, and kind of what the benefits and downfalls can be for that. So next episode, we're going to get into a few more kind of details. And so appreciate y'all listening in. We'll see you next year.
Thanks, guys.
Thanks, guys.
Again, thank you guys for tuning in. I'm going to go ahead and list some sponsors off here. We're going to start with Whinstone Private Lending. This episode is brought to you by Whinstone Private Lending, one of the top private and hard money lenders now serving Northwest Arkansas. Whether you need short-term capital for a flip, a bridge loan, or creative financing, they've got you covered with very flexible products to fit nearly any deal, including 100% financing. What sets them apart is their deep expertise, fast response times, and ability to think outside of the box to help investors like us close quickly and efficiently. If you're looking for a real lending partner, check out Whinstone Private Lending. Link is in the show notes. Our next sponsor is Advantage Title and Escrow. They're a local company. They do great work. Specifically, Kayla Phillips. I can speak personally on this sponsor because I use Kayla for all of my transactions. It's been 2, 3, 4 years now, and Kayla and I have done a ton of deals. We probably do between 65 to 80 deals a year together, and they do a great job. The SOPs, so systems and processing that they have over Advantage Title is just incredible. Clients love it. They do a great job from start to end communicating. When I give a deal to Advantage Title and Escrow, I know that it's going to be taken care of. There's no second guessing. I almost am able to treat them like a second transaction coordinator to my transaction coordinator that I already have. I know that they're going to handle the systems and processes correctly as an agent, as a homeowner, as a buyer or seller. They do an incredible job of handling a transaction and communicating throughout the process. They do a great job with communication, especially Kayla Phillips over there. I would highly encourage you, if you're looking to close on a home, buy a home, if you're an agent listening, to use Advantage Title and Escrow, specifically Kayla Phillips. So you're going to reach Kayla best at 501-358-1601, or you can email her, Kayla, Cayla, at goadvantagetitle.com. Advantage is ADVANTAGE title.com. Banks are about community, and Century Bank of the Ozarks has been your community bank for 131 years. That's over a century, since 1894. They've been helping neighbors build homes, grow businesses, and plan futures. Because they're locally owned, your loan approval happens here, not miles away. Visit their locations in Fayetteville and Mountain Home, Arkansas, as well as Gainesville, Theodosia, Bakersfield, and Ava, Missouri. Century Bank of the Ozarks, local bankers make local decisions since 1894. Member FDIC and equal housing lender. If you enjoyed the show, make sure to give us a follow on your favorite podcast platform so you never miss an update.
Don't forget to connect with us on Instagram, Facebook, and LinkedIn for more real estate insights and behind-the-scenes content.
Have a question you want us to cover? Send it our way. And if you're interested in sponsoring the show, visit nwainvesting.com to get in touch. Thanks for listening, and we'll see you next time.